Welcome to another episode of Coffee with Ken and Dara. We're here with Andrew Fisher, and we're going to be discussing cross-border finance. Andrew is a specialist in this. He's a wealth manager helping foreign buyers and sellers. He's also very good at helping Americans who are deciding to move to a foreign country from the U.S. This is a big question that comes up in my real estate circles. As you already know, I work with a lot of foreign buyers and sellers. And I have for quite a few years now, 10 to 15 years. We wanted to discuss foreign families moving to the U.S. from other places. One of the questions I had for you, is there anything that's tax smart to be done prior to moving to the U.S.?
Yeah. Well, as you know, Ken, I'm a wealth manager for international families crossing borders, usually where there's a connection to the U.S. Certainly for foreign folks, there's a lot of interest in coming here to live in California, both for the lifestyle, but obviously for the career opportunities as well, the tech industry, what have you. And I work with a lot of those folks, both from when they are early on, first deciding whether or not to move or whether to accept a position, all the way to after they've arrived. But to your question, as far as before they move here, there's an interesting thing about a foreign person coming to the U.S. is they become a U.S. taxpayer if they become a U.S. tax resident. And we have a pretty unique tax code compared to the rest of the world, whereby as soon as you become a U.S. taxpayer, your worldwide assets are subject to U.S. tax. That's pretty unique from the rest of the world. So obviously for someone considering moving here, let's say from Europe, Australia, Asia, what have you, actions they can take now that can save on tax, that can, like for example, realizing gains, if they're able to realize the gains on a stock portfolio or on a residence before they move here, they're gonna remove that from being a taxable event here in the U.S. The second they become resident here, they sell a big stock portfolio at a gain, it's going to be taxable here. And if they're California, of course, both federal and state. Yeah. So things like that can be really smart. The other thing I see is there's often structures that are created internationally. You've lived in Switzerland, Liechtenstein. There are certain international structures that can make sense to hold a business or to hold assets like offshore holding companies, foreign corporations that can be problematic. And if you know you're going to come and be here for the long term, it might be good to clean that up because the IRS doesn't always like that.
The other question I had was, how does this affect, if it were me as a foreign person, my personal income tax situation, tax on business and employment income and foreign pension income,
right,
as well as double taxation?
Yeah, I mean, we're primarily wealth advisors, so we're managing investments, helping people make smart financial decisions. We don't do taxes, but of course taxes drive a lot of the decisions that people make. No one necessarily moves to California to benefit their taxes, but for a lot of folks from Western Europe, I've found it's really not that much worse, when you look at the total tax environment. But of course, as soon as you become a U.S. resident, whether you're working or not, you're subject to U.S. taxation, which is going to look worldwide. And so again, as I said earlier, it might make some foreign structures you have maybe not work the way they were first intended. For example, if you have an offshore corporation intended to keep money out of the UK or out of Spain or what have you, those aren't going to necessarily work once you're a U.S. resident. So really, I think the way to look at it is the U.S. is going to seek to understand all of your sources of income, and they're going to tax all of them. There is a system of foreign tax credits to eliminate double taxation. A lot of people worry about the threat of double taxation. And I would say that our system, the system of foreign tax credits, does a pretty good job in almost all cases of eliminating that. So you don't have to worry that you're going to pay tax on some distribution or some income in a foreign country and then pay an additional tax here. That's not always the case because there are foreign tax credits federally that California state does not accept. So there is, potentially some additional tax that just people need to be aware of and understand.
And you can provide a tax attorney or a tax
Absolutely.
Tax person for
I mean, we have an ecosystem, and I would include you in that ecosystem of professionals, whether they be real estate, tax, investment, estate planning, and legal that can help answer a lot of these. Immigration, of course. Yeah.
How will the U.S. tax my foreign investment portfolio? Where should I hold my investments?
Yeah, this is a huge issue, particularly for those folks, in retirement, living off of a portfolio, because the U.S. really doesn't want its taxpayers to hold their investment capital outside of the U.S. And there's certain rules around, it's called passive foreign investment companies. They're tax rules that make it less desirable to hold pooled investment vehicles outside of the U.S., really encouraging them to move them here to be at a Schwab or Vanguard or Merrill Lynch or what have you. We hold most of our clients' investments at Fidelity Investments.
Okay.
The certain types of investments can't be moved, right? Yeah. Namely, retirement accounts, types of tax beneficial structures, like a 401k that we have here in the U.S.
Yeah.
Many other countries have structures like that. Those can't be moved here. So it's a little bit nuanced. We really try to dive in. We build a picture of all of their investment assets, try to understand what type of structure they're in, what the investments look like. A lot of times the investment solutions here in the U.S. are quite a bit more efficient, lower cost. We kind of have the Vanguard thing going on here. So compared to Western Europe and other parts of the world, it can be pretty beneficial, but that does mean liquidating investments, moving from one advisor you've used for a long time to someone here. Right. So it's not easy. And I would say it's a process. It also depends a little bit on how long you intend to be here. Some people come and they want to try it out for a year. And then maybe those wholesale changes they might make gradually over time, depending on how the lifestyle in Marin works out or how the job at Apple works out.
What are the estate planning issues for my family and tax on potential inheritance I receive from abroad?
Yeah, this one is also nuanced. A lot of these issues are nuanced and very individualized. But in general, I can say that, this really splits between if someone decides to become a U.S. resident or not. If they become a U.S. resident, a lot of the estate planning issues are very similar to you and I in terms of the 12 million per person exemption and what have you, 10 million, whatever that is. It's large. It often doesn't hit a lot of families. If they have, but then again, there are international assets, and generally most international estate tax treaties will allow each country where an asset is located to have the first right to tax that asset in an estate tax or upon death. So this is one of the issues that families that have affairs in multiple countries just invariably have to deal with. And oftentimes it's unknowable exactly how complicated it's going to be for their surviving heirs. For non-residents, which I don't work as much with, I know you work with a lot of folks like this, maybe just want to have a pied-à-terre or a landing spot in the Bay, but they're from Germany or China or Australia, what have you, but they're not a U.S. resident. There are totally different rules around a foreign person holding real estate in the U.S., and it can be pretty onerous in terms of the tax they would owe the U.S., but there are structures that can be put together. If the asset is large enough, it can make sense to build structure like a foreign corporation that owns the U.S. asset that can insulate them. So it's sort of, again, it's complicated, but you need to find help. It's not something that can't be done.
Should I sell or rent my former residence abroad, understanding taxation of real estate gains and exclusions on primary residence? What's your take on that?
Well, that is a huge thing we see for people who often they're moving here, they're working here, right? So they become a resident right away. And a lot of these folks are pretty talented, so they've come into a pretty senior role. It's a pretty good life, right?
Very good life. Yes.
So they have this question about their former residence. Almost all of them hold on to it initially.
They do.
And rent it out. But what they need to be aware of, and we see that actually. We've seen people who have kind of been career movers, and they've bought and then held that property with every move. So we've met people with 5 residences in 5 different countries. It's hilarious, and they've mostly done pretty well given the last decade of real estate appreciation. Not that it's altogether easy because of property management and home maintenance and that type of thing. But I would say that one thing we often see them missing are our real estate gain exemption rules, whereby a married couple, doesn't matter if it was bought 20 years ago in London and you only moved here a year ago after it had appreciated, you're going to owe tax here on the full amount adjusted for US dollars from the original purchase date as gain if you sell it. So if you move here, you have to be cognizant of the US rule about having lived in the house, what is it, 2 out of the last 5 years. And so as you're reaching that 2.5 year mark, a lot of people, and it's up to 500,000 of gain excluded, right, from their tax. I've told people at 2.5 year mark, just sell the unit you own and buy the one across the hall. Because you're giving up. Yeah, you're giving up $500,000 of gain exclusion. Again, not knowing exactly what the tax ramifications might be in the foreign country.
Right.
So that's something they got to be aware of as well.
I didn't know that either, so thank you.
Yeah.
Just understanding the effect of my retirement accounts in the U.S. and abroad. This comes up all the time.
Well,
I'm sure for you, not me. But.
The retired folks might have retirement pensions, whether they're defined benefit or defined contribution, cash value or some kind of a pension. Those are fine once you've moved here. But the folks that move here and they're still working, they're still earning, they have a lot of question around, well, I have these old retirement accounts. Can I bring them over with me? Generally, they can't. And then how do I avail myself of the accounts, of the different features available here, right? 401ks, Roth IRAs, annuities, and all the different products here. And generally, these are high-income people. And so these tax advantage savings plans often are pretty smart for them. So, but then, so most of them do participate in things like 401ks. They max them out, which is great, building up a balance. But then they end up having the question, okay, well, this makes sense why I participate, but what happens if I choose to move back home? And then and it's similar to in the other direction, right? Where and those can't be moved. They can't be taken with, unless you liquidate them and pay all the tax and penalties.
Who wants to do that?
They're generally stuck. And so we actually have a number of clients like that where they were here for many years, they went back home, they maybe ended up even giving up their green card or whatever, and they just have a retirement account back in the U.S. But remember, they avoided a lot of tax when they contributed to it. So making sense of those, optimizing all that, making sure that what you left behind that has to stay there is configured as smart as possible. Because a lot of the stuff that we dive into the details and help them with. It's not insurmountable. It's just like anyone who's lived all around the world. You're going to have bank accounts and old employer retirement accounts, maybe small pensions that you've left behind in different places, and that's not unusual. And it's it's manageable. It's just getting into the details.
Got it. Explain the foreign asset reporting requirements. What's that about?
Well, there's a thing called FBAR, foreign bank account reporting, and there are other names for it, and it often goes beyond just bank accounts. Really, it's most any foreign account of any kind, financial account, bank account, retirement account, brokerage account, needs to be reported back to the U.S. And that really follows along with FATCA, which is sort of the new law we've discussed in the past. It's this international financial reporting law that kind of was pushed into gear by the U.S., but most other foreign countries are sort of a party to it. after kind of the 2008 scandals. And it's really, the world is moving to much more of a reported world, right? You know, the stolen